appraisal, sometimes referred to as capital budgeting, which is relevant to the managerial finance paper at the professional 1 level of the suite of CPA examinations. It's a question and an area which is a regular feature on the paper and very much an important part of a management accountant's or financial manager's role within the workplace. Let's first of all set the context of investment appraisal. What we're looking at essentially is typically capital budgeting, where there is a requirement or an expectation or a proposal to spend a significant sum of money immediately with a view to the generation of future cash flows over an extended period, future cash inflows, should I say, over an extended period. Now, we use investment appraisal techniques where the cash flows pertaining to a proposal extend beyond 1 year. They may go on for many years. A good example of that might be the companies which fund the investment in Ireland's road infrastructure, the PPS, public-private partnerships, pertaining to generating toll revenues. So these companies might have to incur tens of millions initially to build those roads and those toll stations, and the revenues generated therefrom may occur or take place over a 20-30 year future time period. So we're looking at such decisions where the cash flows extend for more than 1 year. Typically in examinations they tend to extend to 2 to 3 to 4 years at maximum, given the limited time available in an examination. Now, the difficulty we have, or the problem that this poses, is that money has a time value. As you're all aware, money today is worth more than money any time into the future, assuming we are in times of inflation, which is generally the case. There are many reasons for this. Perhaps the most significant reason is that inflation does erode purchasing power of money over time. So one can buy more goods and services today for that amount of money, same absolute amount of money, as you will do at any point in time into the future. Another reason why money is a time value is because people would prefer today's consumption than tomorrow's expectations. So you'd rather spend now than think about spending into the future. So it confers a value on present consumption. So with this time value of money, what must we do? Well, at a technical level, we need to discount. We need to consider the value of money into the future and what it is worth today by discounting it back to its present value. Please be aware in examination questions that there may be different acceptance criteria set to determine whether a proposal is acceptable or not. We talk about what they are at a later stage, but it's important that in the examination that you look for the precise investment criterion or indeed criteria which need to be met in order for a proposal to get the green light, as the case would be. And finally, over and above the technical quantitative analysis, we also need to think about the wider factors, or what we refer to broadly as qualitative factors pertaining to a decision. These qualitative factors are important, and it's for the management accountant and the accounting community in general to be able to contribute to that wider debate, as the case would be. We'll talk more about those in a moment. Let's look at some of the technical issues we need to allow for or be capable of dealing with as we approach such investment appraisal questions. As we said, to allow for the time value of money, we need to deal with a common currency, which is present value. So the job at hand is to discern which cash flows pertain to the proposal and over which period they occur. So we need to tie down exactly which future year each cash inflow or outflows occurs. And then when we get a final net cash flow figure for each relevant future year, it's important that we discount those future cash flows back to what they are worth today. Please be aware, of course, that the further out from today that those cash flows take place, the less value they will be worth today. Obviously, they are discounted more heavily or progressively, as the case would be. Students should be be aware that discount tables, be they the annual present value tables or the cumulative or annuity tables, are always given in the examination. They can be calculated, but strictly speaking, there's no need to do so in exams because those tables will be provided to you. It's important, of course, that the student is able to discern what the discount rate to be applied in a given investment appraisal is, and read the question carefully in that regard. Lots of questions will simply state what the rate of discounting should be, or the cost of capital. In other questions, you will have to discern that. Sometimes that may involve calculating the weighted average cost of capital, or WACC, or in some cases we may be raising, let's say, investment-specific financing, and that needs to be considered carefully. A good example of that might be on question 1 of the April 2011 managerial finance paper. We had a question called BBN PLC, which is a proposal for a hotel to upgrade its facilities from a 4-star to a 5-star establishment. The capital requirement in that question was 10 million up front, and the question says, close to the end, 3 paragraphs from the requirement, it says, for the purpose of financing the proposal, the company intends to raise debt finance of 10 million at a rate of 10%, so that would be the interest payable on that, and indeed that attracts tax relief at 20%. So in determining the discount factor to be used for that particular proposal, the appropriate approach was to appreciate that the 10 million was debt financing, on which you're paying 10% interest, less the tax sheet of 20%, so effectively the cost of financing that was 8% to the proposal, and that's what was used in the solution. So students need to be aware of where the discount rate comes from, be it stated or be it a requirement for you to calculate same. Another technical analysis issue which is relevant to decision making and investment appraisal is the concept of year 0. It's important that students appreciate that this is a concept which you will only see in this context. And year 0 refers to the year in which any immediate expenditure will take place. Now, it's typically an initial outlay, as was the case in that question in BBN, where they would have to spend 10 million immediately to upgrade their facilities. And this year 0 is used because when we're converting all future cash flows back to present value, it's important to appreciate that anything happening today does not need to be discounted because it is already at today's present value. And as you're probably aware that all year 0 cash flows have a discount factor of 1. In other words, they are not discounted, as distinct from future years cash flows, which are discounted progressively from the future back to what they're worth in present value terms. So be aware of that rather anomalous term, which is a very important feature of investment appraisal questions. The real challenge for students is to determine all the relevant cash flows, inflows and outflows pertaining to the proposal over the period for which the investment criteria is required to be analysed. So typically that involves maybe significant numerical calculations to determine the income streams and indeed the future costs pertaining to the proposal. It's important in this context that students can allow for inflation, whereby you inflate costs in accordance with maybe broad RPI inflators, or indeed with cost-specific inflators such as wage rate agreements which have been agreed for our pay costs. It's important that students appreciate that non-cash items such as depreciation and notional charges do not form part of the investment appraisal. We are only interested in cash flows. You've heard of the term discounted cash flow. That would further accentuate that point. Anything of a non-cash nature needs to be excluded from your analysis. Some questions may require you to consider the taxation impacts of the proposal. Please read questions carefully. If a question says ignore taxation, well, that's precisely what one does. If a question asks you to consider taxation and gives you details pertaining to the taxation legislation which is appropriate at that point in time or jurisdiction, it's important that you apply that. In essence, what one needs to be aware is that tax payable or refundable also represents a relevant cash flow to the proposal which must be considered in your investment appraisal. If you're considering tax implications, it's important that you're aware of the capital allowances regime whereby, based on taxation legislation, companies are given an annual allowance for capital items, and then when the project comes to an end, or indeed the asset in particular is sold, it is subject to a balancing allowance or balancing charge calculation. It's important that students would be able to deal competently with such matters. There are other questions in the whole area of investment appraisal which are rather peculiar or specific questions which students need to be able to deal with. Some of those will include determining the optimum replacement cycle of a particular asset. And indeed, some questions may require you to consider whether it is appropriate to lease or indeed to buy a particular asset, and that will also involve consideration of tax implications. So there are two very specific type questions which could be asked as distinct from the general broad investment appraisal question. And then at the very end, it's very important that students will apply the requisite investment criterion, if there's one, or criteria where there's more than one, and provide investment advice to discern what the bottom line figures are, and then to apply the criteria thereto to advise management as to whether or not the investment on financial grounds should or should not take place. As mentioned previously, please do read very carefully the question to ensure that you discern precisely which investment criteria need to be applied. What might those investment criteria be? The first one, typically where businesses are cash-strapped, which may be relevant, particularly relevant in today's world, would be where a minimum cash payback period is set. In essence, what one must do, one must track the cumulative cash flows pre-discounting of the proposal, and then discern in which year the cash eclipse takes place, if indeed that ever is the case. What I mean by cash eclipse is where cumulatively we go from a cash outflow position, as is typically the case in such questions, to a net cash inflow position, and the year in which that occurs is that year of cash eclipse, which can be compared with the payback period set out as an investment criterion. Some questions may require you to look at discounted payback, which is slightly an anomalous term, whereby we discount the cash flows and then we discern the year of cash eclipse in that context. Just be aware that the technical approach is exactly the same, whereby we track the cumulative discounted cash flows and determine the year of cash eclipse. Many questions ask the student to calculate the net present value or NPV of the proposal. I think those words speak for themselves. The net, which is the final figure, of the present values, whereby all the future cash flows are discounted back to what they're worth today, i.e. their present value, and then we net that whole position down to discern whether the net present value is positive or negative over the time frame which is set as an investment criterion. So, for example's sake, if a question requires you to deliver a positive NPV within 4 years, well, the expectation on students would be that they do a 4-year analysis plus year 0, of course, and discern what that NPV is at that point in time. Please be aware that if that was the question and there were cash flows pertaining to years beyond year 4 into year 5 plus, that a student who calculated those figures from year 5 onwards, that would probably be wasted effort in an examination, given that the expectation, the requirement is to investment advice pertaining to the investment criteria as set out in the question. So please be aware of that. Time is precious in the exams, as you're well aware. We really do not need to go beyond the particular period which the investment criteria requires. And then finally, you'll have heard of the concept of internal rate of return, which basically is the discount rate at which we achieve a zero or break-even net present value. It's important that students will be able to apply the mathematical technique of interpolation to find the exacting internal rate of return for a proposal. This will be compared against a benchmark IRR set out as an investment criterion, and thereafter it's up for the student to discern and give advice as to whether or not it meets that particular criteria. So it's important that you're aware of which criteria are set out in the examination question and apply those strictly to your workings and give appropriate investment advice on that basis. Finally, no decision, particularly capital budgeting or investment appraisal decision, is complete without the financial analysis, but you also have to concern yourselves with the wider qualitative analysis. In other words, the impact upon your wider stakeholder community. So once the financial analysis has been completed, one needs to consider the impact that it would have on, for example, customers. Will it provide future business or vice versa? On suppliers, likewise, what will it mean for our suppliers? What will it mean for our employees and for employment prospects? Very important consideration in today's world. This decision may provide significant employment opportunities and vice versa. This will need to be considered. The impact such investment decisions will have on public relations. If the decision is to close down a factory, for example's sake, that may have significant adverse local public relations or PR, and that may impact adversely upon the organisation's future workings or fortunes, as the case would be. And then finally, in today's world, we must always have one eye on the corporate social responsibility agenda, or CSR. What does this decision mean for this particular issue, this particular concern? This would have to be considered. So to summarise, the whole area of investment appraisal is a very important area in the world of finance, a particularly significant area in the paper which is managerial finance at professional 1 level. It requires students to understand technical analysis points. It also requires students to be able to discern where cash flows, inflows and outflows pertaining to the decision are coming from and in what period. And also it requires students to consider the broader issues pertaining to a particular investment decision, as the case would be. If one was to look at all the past papers, certainly since the managerial finance paper was introduced, you will see that investment appraisal is a regular question on such papers, and that those questions typically take a pretty similar format insofar as the technical analysis is required first, and thereafter